Wall Street Unplugged looks beyond the regular headlines heard on mainstream financial media to bring you unscripted interviews and breaking commentary direct from Wall Street right to you on Main Street.
How's it going out there? It's February 28th, and I'm Frank Curzio, host of the Wall Street Unplugged podcast, where I break down the headlines and tell you what's really moving these markets. You know, I've come across all types of personalities, my 20-plus years of being in the financial industry. And it's funny how personalities can be so different. You always have your outgoing people, your shy people, those friends that are arrogant, the people who are pissed off like every minute of their lives, even though they're retired, they play golf 4 times a week, they're healthy, have kids or grandchildren, live in a great free country, yet they're just, pissed off at everything all the time. You know what? I have no problem with complainers, as long as they don't complain to me all the time. Because like everyone else in this world, I have my own set of problems, responsibilities, millions of things going on. I really don't have time to hear you complain about your mailman delivering the mail after 11 a.m. instead of in the morning. And you can't believe how cold it was this winter in Florida. I mean, dude, you live in Florida. It's like 56 degrees here in January, where it's 10 degrees in just about every other place in America. They got to complain. I get it. But the people I hate dealing with the most are the ones that show no emotion, especially when there's a great opportunity in front of them. Like if I hire someone, I want to see emotion. I wish someone that's ticked off at that last employer. They didn't see your potential. They didn't give you credit for anything. You want to get hired by a competitor, you want to destroy them. I want you to tell me how great you are, how you learn from past mistakes, how you're a team player. You want to see that excitement, especially during an interview. And for example, and if you're a young person out there and have a job interview coming up, I'll give you some great advice here. Best advice I can give you, especially if it's a competitive job. We know hundreds of people are applying for it. A lot of those people are more qualified than you. So you're going in there, you're all nervous and stuff like that. But I can tell you, if you first walk into that room, and I don't care if it's one person or 10 people doing the interview, because a lot of times we have interviews, it's like 3-4 people there now. It should be a little intimidating for some people. But I don't care how many people are in the room. Once you sit down, don't even say hello. No thanks for seeing me. None of that. I appreciate none of that. Just look them dead in the eye and ask them, when do I start? I know, it sounds crazy. But if I was interviewing someone and they walked into my office the first time and said, hey, when do I start? With confidence. It'd be dead serious if you say it. It's not a joke. You want to be 100% confident, more like Michael Jordan in his prime, and he's trying out for a high school team. Right? Jordan will walk in there and be like, okay, what time is practice start and who are the other 4 guys starting alongside of me? That's how you want to be like when you walk in an interview. And think about it. Because once you do this, right, you're asking, when am I starting? Again, right off the bat, no hellos or nothing. It shows confidence. It shows enthusiasm. And I'm not talking arrogance, because there's a huge difference between being confident and arrogant. 2 totally different things. Because by saying this, and the first thing, you just separated yourself from the rest of the 200 people about to be interviewed. You're going to be remembered right off the bat. And you're in control of the interview. Because I'm going to have to come back to you and ask, why? Why should I give you this job for? Who is this person? Why are you so confident for? That's what I'm thinking in my head. Like right away. And you know what? The floor is yours. You just skip through all the BS, which is mostly what? Hate to say it. I mean, the curse here, ass kissing. Like, thank you so much for giving me this opportunity. I love your company. It's my dream to work for you. You get rid of all of that. You get rid of the person who's looking at so many different resumes. He has no idea who you are. Who's going to forget the second you walk out, but they're going to go line by line over your resume, which is kind of crap anyway, right? If I hire people based on their resume alone, I would probably wind up firing every one of these employees a few weeks later. Because anyone can write anything on a piece of paper. And everyone's resume looks great if it's written well. And when's the last time you saw on a person's resume where it stated, I'm not a team player, or I don't work well with others, I can't handle deadlines, I need to leave at 5 p.m. every day? That's not there. That's not on anyone's resume. It's all written. You went on whatever site, You had your friend write it, who's a professional at that, a great writer. But it's just a piece of paper. But you know what you can't put on a piece of paper? Determination, will, confidence. And that needs to come out in an interview, especially if you want me to hire you. So I pretty much know within the first 10 minutes of a conversation if I'm going to hire you or not. Because I've interviewed people where they have zero expression, no enthusiasm at all, no matter what the situation is or the opportunity in front of them. They're like, yeah, sure, that sounds great. Thanks so much for the interview. Like same tone all the time, zero emotion. And if their house is on fire, they'd be like, damn, my house is on fire. I should probably get out of here before I burn to death. I mean, you ever see people like they just have the same emotion all the time. And it's like these people went on some crazy, cult retreat and got brainwashed. And just the same tone. They kind of never cursed in their life, no matter how mad they get. It's okay. They get that out a little bit. It reminds me of a good friend of mine, Steve Sugarroot. He's a fantastic analyst, works for Stansberry, good friend, actually lives close by me, who rarely curses and really rarely loses it. At one time when I was working, he just, came out of his office. He's cursing. He's angry. And I felt terrible because I just started hysterically laughing. And I'm bad like that when people are out of character because, if you're a nice level-headed person and just lose it, I think that's awesome. I love to see that. And I feel bad because it's not like I'm making fun, but it's just great to see all that emotion come out because it's going to come out one day or another. And if you hold it in, you're just going to explode one day. But every person I hired for Curzio Research just knocked it out of the park during the first conversation with me. They couldn't contain their enthusiasm. They couldn't wait to start. They had that chip on their shoulder, like they have something to prove. No BS type of attitude. And those are the employees you really want working for your company. And when you find people like that, reward them. Provide incentives. Go out of your way to make them happy. It doesn't always mean you have to pay them more money. Although I never met an employee that doesn't want more money, no matter what you pay them. It's like, putting a mouse in front of a snake. No matter how nice your snake is, he's going to strangle the mouse to death and then eat him, right? Because that's the normal reaction. That's what you do. That's what I did even when I was at other companies that paid me. Yeah, everybody wants to get paid more money. It's natural. But it's not always about the money as an employer where you could find out what sport they like, go to a game with them, buy lunch for them, show them appreciation of how hard they're working. I mean, it's a big deal. As someone that at one job or two jobs where I didn't get appreciation, I went the extra mile and nobody really cares. What does that result in? It results in me, you know what? I'm not going to stay late for you. You don't even no thank you. No, hey, listen, I appreciate it. And one of the companies was going through tough times. You'll find a lot of people at the time. But I get it. So you're taking over other people's jobs and there's still no thank you, no nothing. So, how do you think that's going to translate if you don't really appreciate those employees? But the point of this, should probably say, Frank, where are you going with this? Kind of a mini rant here. But Curzio Research is hiring right now, and we need to fill two very important positions because we're always looking to hire more people, more great people. So one of those positions, you're going to be dealing directly with me, which could be a good thing or a bad thing. Most of the time, it's a good thing. Most of the time. It's depending on how hard you work. So we're looking, the first position is a podcast production manager. So someone with experience, knows podcast world well. Find and keep schedule guests to interview, which I can help out with this since you're basically given access to my entire Rolodex. We'll be able to post show notes to Lisbon, to iTunes, to our website. Make sure all episodes meet requirements for publishing. And also publishing Mike Alkin's podcast. Guys, you have to listen to it. Mike Alkin just started a new podcast. It's awesome. Talking stocks over a beer. He just interviewed me on Monday. Pretty good. A lot of fun. Definitely check it out. We posted his podcast everywhere. Write show notes for our site and podcast descriptions. Create marketing content around it, which includes using social media, working directly with our marketing team. But you're going to be working directly with me. Pay is very good. If this is something that you're interested in, send an email, frank@curzioresearch.com. This process worked out fantastic. I was able to hire great analysts. I interviewed 3 other amazing people after getting hundreds of resumes in. It worked out fantastic. It was great. So let's try it again. Because the next position is a digital marketing director. Your responsibilities is laying out post, email, editorial content, marketing emails, create marketing emails, lists, and targets, build tracking links for internal, external content efforts, post content on social media, the qualifications, CMS, CRM, email marketing program experience. It helps if you're familiar with programs like ActiveCampaign, ClickFunnels, has offers. Ability to multitask, work well under multiple deadlines, excellent written and communication skills, social media marketing experience. Another position that pays well, but we're growing, we're hiring, and we want to get good people. And I want to try to tap the amazing network that I have, which is you. And you helped build this company with me. The only reason why this worked and why we're growing and why we're doing well is because of you, because we've had so many followers on this podcast, which you're able to translate into people buying subscriptions and growing the business and providing excellent advice, the best out there to everyone through our newsletters. That's what it costs of you. I know how many brilliant people out there. You guys email me all the time. I used to answer every single one of the emails, but now the podcast is getting bigger and bigger. We get more people, so I try to answer them. I read all of them. Believe me, I do. Not lying when I say that. So I'm looking to hire motivated people. I say this where it's not, looking to hire someone just for a paycheck because I got on anyone and pay them, but someone who loves what they do, the podcast world, loves digital marketing. They can be working at a place where it's the ground floor. So there's plenty of room to grow as our company grows. If this sounds like you're interested, send me an email, frank@curzioresearch.com. That's frank@curzioresearch.com. Which position you want, which is digital marketing coordinator you're interested in, or podcast production manager in the title. A few sentences about yourself. Feel free to send your resume. Of course, I'm going to call you, though. I would like to see your experience a little bit, even though I just talked how bad resumes are, but I would never hire anyone just on their resume. I need to talk to them a few times. I need to see that enthusiasm. That's very important to me. But either way, resume, a couple paragraphs about yourself is fine. Reach out to you if we're interested, which we are very, very interested. The more people we get, the better. And we're looking to fill these positions right away. Now, one thing real quick here. Our office is located in North Florida. I'd like to have someone that could work on site, but it's not a requirement. However, you're definitely going to have to travel here a lot, especially early on, learn our systems and have to get to know our team, especially face-to-face, which is very important. Makes it a lot easier to work with everyone when you know who you're speaking to, when it's not just an email, you never saw these person or met these people in person before. So again, if you're interested, this sounds like you want to come to a really good company. I mean that. I'm not being arrogant when I say Curzio Research is a good company. And we hire great employees, people that love what they do. It's a lot of fun here. It's really cool, and we're growing. If that sounds like you, send me an email, frank@curzioresearch.com. That's frank@curzioresearch.com. So, moving on. Have a great interview set up for you today with my buddy, Marc Lichtenfeld. Marc's Chief Income Strategist at the Oxford Club, Senior Editor of the Oxford Income Letter. He's also an author of a new book called You Don't Have to Drive an Uber in Retirement. Great analyst, also covered biotech for most of his career, including the years I worked with him at TheStreet.com. Someone I interviewed about 7 weeks ago, and he was about to attend one of the biggest biotech conferences in the world. That's the JP Morgan Healthcare Conference. I told him, make sure you come back. Let us know if you have found any new ideas, which he has. So biotech's been a sector that's pretty much been out of favor lately as the market's been going higher. So I'm looking forward to getting Marc's opinion on if it's a huge buying opportunity in the sector or not. Getting a lot of those ideas. He's going to also share a few income stocks with you since he's a Chief Income Strategist of Oxford. And I love having Marc on because it's a great interview, always comes prepared, and one of my guests that's always going to give you stock ideas, which I know you love. In my educational segment, got a pretty cool one today. I'm going to share my favorite tool with you. Mostly like a strategy. The one I use to find my best ideas. And I'm not talking about traveling around the world or networking with my buddies, or just, tap my Rolodex. There's a strategy any one of you could use, and I promise it's going to lead to more, not just more ideas, but original ideas you're not going to hear mentioned in the media. Now, what does that mean? It means you're going to be able to find stocks before they get all this attention on blogs, on media, and everyone starts talking about it before they hit the technical levels and they go higher and they get on all these lists and they get momentum behind them. This is the best way. This is the way that I've been able to find names completely out of favor. Again, it's a strategy everyone could use. And when you get in these names early, what does that mean? It means you're going to generate maximum returns for your portfolio. That's how it helps when you get in early. So it's a great segment coming up. Man, maybe I should be giving all this stuff away for free. I love you guys. Love sharing ideas, strategies, going to help you make money. Money that you will, of course, you subscribe to every single newsletter we publish at Curzio Research for the rest of your life, or the rest of my life. Still haven't figured out if that's your life, my life, if that's good or bad. But we'll figure it out for all those lifetime memberships. So before I reveal this incredible strategy to you, let's hear from my buddy, Marc Lichtenfeld. And here's that interview right now. Marc Lichtenfeld, thanks so much for coming back on the podcast.
Hey, always great to be with you, Frank.
Well, I want to start out with the markets because you wrote something interesting, and this is on Investment You guys. If you want to check it out, it's where Marc writes a lot of his work. Marc also has a bunch of newsletters as well that I mentioned earlier. But one interesting thing that I read is you were saying when the market sell-off happens, or this market sell-off, it's kind of like a roller coaster. And I like the fact that you were like, hey, this is kind of normal because when you put on TV, it's almost like the end of the world. This is it. And everybody compares it, and I don't blame them. I'm not making fun of anybody, but they compare it to the last major pullback in the market, which is really the credit crisis. And I think the credit crisis is going to happen all over again. And I read your piece and it was kind of like, hey, calm down. Could you explain exactly what you were telling your subscribers during that time? And this is a couple of weeks ago when the markets were crashing. We sold off more than 10%, and there was a lot of people nervous.
Sure. So, yeah, when the markets fell, and they fell pretty quickly a few weeks ago. So people understandably were very nervous, and especially with the stock market having been on such a strong run, and people worried, or is it too frothy? People were really nervous and wondering if this was the end and if they should take all their profits and move to the sidelines. And, you know, we don't try to time the market. So I'm not telling anybody that, yes, we have 2 more years of the bull market to go, or, you know, the target on the Dow is 30,000, nothing like that. But it is important to remember that in bull markets, these things happen, and they happen pretty regularly since the beginning of this bull market in 2009. We've had 5 drops of over 10%. And in fact, and the statistics I quote, if you go back to 1980, every year, with the exception of 2017, it's the only time this didn't happen, every year the market drops at one point an average of over 14%. So obviously, you know, some years it might only be 4%, other years it'll be 20%, but you know, at least once a year there is some kind of a decline that averages 14%. So even in a healthy market like we're in now, you get these declines, and sometimes they're significant. So it was just kind of a reminder that this is absolutely normal. And if you're a long-term investor, you know, not to bail, you know, but buy the dip if you have some money sitting on the sidelines, because this kind of thing happens all the time.
Now, Marc, I've been doing this for over 20 years. You've been doing this for a long time. But the recent pullback a couple of weeks ago, the reaction was something I'm not used to seeing. Where I see people get nervous all the time, but it was like, hey, should I remove my money from the markets? It was like you said, from someone who covers the market, and you brought up some great stats, which I also reminded my subscribers as well. So, I mean, it's like something like 35 years in a row, 37 straight years, we've always had a market correction, except for 2017. And do you think that's it, where the reaction is so big that, and it's not just 2017, where it's the first year in history that the market didn't decline for 1 month. Every month it finished the month higher. And then when you go back, and that's just in 2017, but I believe that trend, I mean, it happened in January as well. But also, the last time we saw a 10% correction was, I think, in the middle of 2016. So we're looking at a good year and a half. Does that have to do with it, where people are just used to the markets going up? Or is it maybe the social media presence this day, where everyone has access to everything and so much media and so much noise? But for me, and I don't know if you saw it, it felt like that reaction was a lot bigger than, at least than what I expected, because it was kind of a normal market, normal pullback to me.
Yeah, I think you're absolutely right. And I think people to some degree have short-term memories. And so the fact that we hadn't had a down month in, you know, over a year, as you mentioned, all 2017, I think people kind of forgot, you know, for lack of a better term, that sometimes markets go down, even if it's temporary. But on the same token, I'll kind of conflict or contradict what I just said. I think people also have long memories, and I think the emotional scars from the credit crisis are still not fully healed. And I think any kind of decline, especially a fast one, makes people, kind of get white knuckled and go, oh my gosh, is this going to happen again? Because people got in some cases their net worth cut in half in 2008, and nobody wants to go through that again. And if it's 10 years later, you have less time to make that up. So I do think that the wounds from 2008, at least the emotional ones, have not completely healed. I think it's something people will probably never forget. Just like probably our grandparents never forgot the Great Depression and what happened to them and their net worth or their kind of family situation. I think that's going to be the same legacy for the credit crisis.
Yeah, it definitely makes sense. And guys, we're not poking fun at anybody or anything because we understand the nervousness, but it's just our job to say, hey, if you look at the underlying fundamentals, it's not the credit crisis. Okay, there's a lot of stops put in place with the banks where they have tons of capital on the balance sheets. They can't lend a lot of this stuff out because they have to keep it in case the market falls 30%, if housing prices crash again, if unemployment goes above 10%. It doesn't mean stocks aren't overvalued and they can't pull back 15%. But that's a big difference from saying it's a credit crisis where our whole entire financial system almost collapsed. But it is interesting to see the sentiment and how quick it was. Like people were just like, wow, what do I do? And, it was amazing. I wanted to see if you were hearing the same thing on your end. Now, the last time you were on, you were about to go to the JP Morgan Healthcare Conference, and I was going to I don't know if I was just going or if I was coming back from the Consumer Electronics Show. And I said, hey, I'd like to bring you back on and see if you saw any trends because that's the basically Super Bowl conference for biotech. We discussed some of the trends during that interview, whether it was gene editing, DNA testing, and I think it was microbiome or something that you said you were very interested in, where it was like gut bacteria, something like that. And I was fascinated because it's something I never heard. What have you seen at that conference? Did you see anything interesting, any names or anything that was different maybe from prior years?
It was interesting. I felt like sentiment there was a little bit more negative than I expected. And, the market's been so strong. Biotech has been pretty strong. So I thought it was going to be, maybe a little bit euphoric. And that wasn't the case. There definitely seemed to be some, maybe pessimism is the wrong word, maybe skepticism. I think it had a lot to do with valuations, also the uncertainty politically as far as healthcare and Obamacare. So there was kind of a bit of a guarded feeling, I thought, at least on the part of the analysts and the journalists, the investment bankers. I mean, the executives always put on a very optimistic show. The biotech company executives, they always tell you how great everything is, and if you really try to press them on some of these issues like Obamacare or politics or policy, they'll really kind of either say it doesn't affect us, which in many cases might be true. If you're a small biotech company without a drug on the market, then you're not really affected by too much policy yet. But that being said, there's always amazing innovation. There's always bankers and traders and analysts chasing the next hot thing, and it seemed like because valuations have gotten stretched and a lot of these stories have been discovered, people are kind of chasing smaller and smaller companies now. And so I found that interesting, that like some companies that, to be honest, I think were, kind of garbage, had big followings and a lot of people trying to meet with them. And so that made me a little bit concerned, I guess. I still love the sector. I love, any sector that is innovating and making a difference in people's lives, money will flow to it. So, long term, I love the sector, but it did make me a little more cautious that you really kind of have to find some gems in the sector now. You can't kind of just throw a dart at the sector and expect to make money.
Yeah, it is interesting too. And your sentiment was right. I feel like I haven't looked at the numbers. I just feel like when I'm looking at biotech stocks, everyone is kind of down. It just seems like, there's a little bit of sell-off, at least in some of the names I've looked at. I haven't looked at the industry as a whole, but it hasn't been exciting. They haven't been talking about it in CNBC. They haven't been talking about it anywhere since January, basically, early January. But it just seems like it's not really a hot topic right now. And I don't know if that's normal, where it's like a seasonal trend after the conferences, and some markets seasonal or cyclical, whatever you want to call them. But not that this is a cyclical market at all, but it's interesting that sentiment seems like it transferred over, at least for 2 months now, where at least I'm not really seeing that excitement or something that stood out. I don't know what it is, but I just, for the first time in a long time, I'm not really excited about finding like, hey, that next biotech, what's going on, and seeing it. And I don't know, maybe it's me, but I don't know if you've seen that as well.
Yeah, I mean, there is typically a bit of a sell the news reaction after the conference. After all the news has been digested, and there's always going to be a bit of a letdown. As you mentioned, it's kind of the Super Bowl of the biotech conferences. So afterwards, any company that had big news usually was going to try to get it out that week. So there might be a lack of big news for several weeks after that. But there are some conferences. This kind of becomes conference season. So some of the other banks are doing conferences, and then really the next big thing will be ASCO in June. It's a big cancer conference in June. That's when a lot of the companies present data. So things are going to start picking up, and you're going to start to probably hear some buzz in the spring ahead of that conference.
No, it definitely makes sense. Marc, I want to ask you one question because we'll get to something really interesting in a second. And I want to stay on biotech here because I don't think I've ever asked you this. When I look at biotech names, I mean, you always want to have a good management team. You always want to make sure, they have enough cash and look at their burn rates and stuff, especially if it's a small company. It's not generated revenue yet. I find the best ideas when they're in phase 1, phase 2 studies and they happen to not meet their endpoint. And then you'll see the stock crash. And it doesn't matter. It just everybody, the sell-off is just everyone's running to the exits. But nobody really reads that news. They don't say that, well, you know what? We just want to see something more. We just want to – and when they submit that, like Aspirion Therapeutics is one company that went from like the single digits to 120. And then it came all the way back down to the single digits because basically they said, hey, there's going to be a delay in this. And they really have to go through all the testing and stuff. And now the thing went back up to 80. I feel like that's where I find the best ideas. So my question to you is, do you have a methodology for picking stocks where, of course, you have to love the ideas and you see the fundamentals, but is there something that you look at that maybe, that you could discuss with my readers who love buying biotech stocks that could lead to new ideas or things you need to see, just a little bit behind the methodology because you've been doing this for a very long time in this area?
Yeah, so I mean, every position is different and every story is different, as far as their clinical trials and where the development. But I guess to paint a broad picture, what I'd love to find are companies that are in phase 1 or phase 2 trials and have data coming out soon because, especially phase 2, that is really kind of the first indication that there's real potential here. Phase 1 is pretty early. Sometimes it's just a handful of patients, and it's certainly positive when the news comes out and the drug was proven either to be safe or effective in that very small sample. But once you get to phase 2, now you're really getting an indication that this drug has potential. And that can often be when a stock really takes off, because by the time you have phase 3, a stock can certainly move strongly on strong phase 3 data. But at that point, expectations are kind of built in, and they can be pretty high. At phase 2, it's really, I don't want to say a coin flip, but it's kind of like, anybody's guess as to whether this drug's actually going to work. So when it does, the stock can really move. And interestingly, that's often where some of the very early investors will get out. Some of the people who funded the company even before they went public. Some of the smartest biotech investors will start to kind of take some money off the table after phase 2 because they know it's still such a long haul, and it's so difficult to make it through phase 3 trials, make it through the FDA. So you kind of get that pop after phase 2, and that's often a good place to take some profits, or at the very least, raise your stop.
No, it definitely makes sense. But it's interesting to see because, as you say, like phase 1, phase 2, you're going to get those expectations in when the stock's going to be a lot higher. And then, if that data doesn't come in positive, a lot of times that's when you see easily a 50% plus sell-off. I mean, you can go to any website that tracks the biggest winners and losers, and you're going to see a biotech on there that's down 50, 60%. You're going to see one that's up 140% every single day. So there's so many of these names. Now, once again, we're talking to Marc Lichtenfeld, and you are the Chief Income Strategist at Oxford. And I want to talk a little bit more about income because you just wrote a book. We talked a little bit about it on the last podcast, and now it's officially released. Why don't you talk a little bit about it? It's called You Don't Have to Drive an Uber in Retirement. And I think it just was released in Amazon, I want to say a couple days ago. Is that correct?
Yes, a couple of days ago, and actually we already hit number one in our category on Amazon. So for anybody who bought the book, thank you very much. We are thrilled to see that number one bestseller flag on the page. So that was really exciting. So the book is You Don't Have to Drive an Uber in Retirement: How to Maintain Your Lifestyle without getting a job or cutting corners. And this really kind of stemmed from an alarming statistic that I read, that 45% of retirees expect to have to work retirement, and that's not working to give something back or to mentor young employees. It was that they have to work to pay the bills, and that was just staggering to me. So I created this book. I wrote the book to come up with ways of generating income, with ways of saving thousands of dollars that are really simple. In many cases, just a mouse click, to save money. But it's not about, well, you should downsize your house. You should stop going out to dinner twice a week with friends, or don't travel to see the grandkids as often. It's really, the idea is live the lifestyle that you have either become accustomed to or that you've dreamed of, but you can do it. You can do it a little bit less expensively, and you can make some money at the same time, and you won't have to go drive an Uber or be a Walmart greeter or do something that you really don't want to do.
Now, to be honest with you, Marc, when I saw this book for the first time before, I really dug into it, I was kind of nervous because this is a really competitive industry. You hear about the strategies all the time, right? It's you should own stocks long term that pay dividends, that have a history of raising those dividends annually, compounding and stuff like that. And I was just hoping it wasn't another book like that, and it wasn't. Could you provide some of the details? Because you actually provide really unique ideas where that I haven't read before, how you could generate more income and different things that you could do where, it's not just stocks and stuff like that. But that's what I found the book was pretty cool, whereas it wasn't like, oh, here comes another income book and there's a million of them. Where I was like, how's it going to be different? And I think you nailed it with that. And that probably explains why it's on the bestseller list, because it is different from a lot of the other income books that are out there.
Yeah, thanks. So I did want to be very conscious of not basically rewriting Get Rich with Dividends and slapping a different title on it. So, I do have one chapter on that for anybody who didn't read Get Rich with Dividends. But you're right, there's lots of other income ideas. So I have one chapter called Be the Bank, where it shows you how you can lend money to various types of individuals and get a high rate of interest on it. You can also be the IRS essentially and have people pay their taxes to you. If they owe real estate taxes, there's an investment you can make where they will pay the taxes to you, and if they don't, you have the opportunity to acquire the property. So I think that's a really interesting technique that people can use to generate some real interest. And a really important one is getting paid more from Social Security. The security is so complex, and it's really important to understand the rules and know how to maximize your payout because you put the money in. So it's not that you're taking advantage of anybody or the government. You paid into this your whole life. You deserve to get every cent you can literally get out of it. And the last chapter on income that I really, really am excited about is called the 401k you've never heard of, and this is for people who have not yet filed for Medicare. So if you've already done that, you're unfortunately not eligible. But if you're working and have an insurance plan that is a high deductible insurance plan, you're eligible for what's called a health savings account, an HSA. And if you put money into an HSA, it basically acts as like an IRA or a 401k for your health expenses. So the money that you put into it comes off your taxable income. So if you make $75,000 a year and put $5,000 into an HSA, your taxable income is now only $70,000. So there's an immediate tax savings right there. And this money grows tax deferred, actually tax free if you spend it on healthcare. And if the neat thing is, so let's say you need to go to the doctor and you have to have a procedure, you can just pay with the money that's in this HSA. that you've, again, put away pre-tax. But if you don't use that money, it can grow tax deferred or even tax free as long as you need it. So let's say if you're a high income earner and you've maxed out your 401k, this would actually act as another 401k. You could put another $5,000 into it, let it grow for years. And then when you're 65 and need the money for healthcare expenses, it's tax free. Or you can even take out the money, again, it has to be after 65, you can take out the money for other expenses, and then you'll just pay the taxes on the growth of that money. But that's only if you're using it, let's say, to pay the mortgage. Again, if you're using it to pay medical expenses, it's tax-free. So it's a really cool way of lowering your current taxes and saving for healthcare expenses in the future. And we know that healthcare costs are substantial the older you get.
Yeah, no, it's great, guys. And look, the name of the book is You Don't Have to Drive an Uber in Retirement. Marc, I mean, it's fantastic. It's on Amazon. And before I let you go, like always, I'm not going to talk about boxing, MMA announcer, which you're professional at. You're on ESPN. I love going over that. And I think actually my audience might be more interested in more of your stories about that. But I know that they're really interested in finding some new ideas. And one of the things that I love, and I know my audience loves when you come on, is you're always sharing new ideas. So do you have any, if it's income ideas or biotech and coming from out of the conference, I just wonder if you have any ideas to share, which again, people love. And I know every time you come on the podcast, so I'm really, really putting you on the spot here, buddy.
Sure. So in biotech, stock that I really like, gene editing and CRISPR is pretty hot right now. So a company I really like, I kind of like to say, was doing gene editing before gene editing was cool. So this is kind of before all the CRISPR stocks came along. It's called Sangamo Therapeutics. SGMO is the symbol. And they have a gene editing technique called zinc finger technology. And it's similar to CRISPR in that it basically, the technology acts as almost like a pair of scissors to splice or to cut DNA, and then they can add the proper genes in there to basically create a medicine, a therapeutic. So they're working on hemophilia. They're working on a couple of very rare diseases. They have a deal with Pfizer, who's given them a bunch of money to develop a drug for ALS, Lou Gehrig's disease. And so they just have a lot of good things going right now. The stock's been performing well for the last several months. So I think that's a really exciting company. And I like the fact that they're a little bit later stage than CRISPR. I think CRISPR is incredibly exciting, but it's very early stage stuff. Sangamo is further along in the process. And then on the income side, there's a few things I like. One of the companies, this company actually just reported a pretty disappointing quarter. So the stock's down, the yield is up. So there's a chance of getting a little bit cheaper. It's Lamar Advertising. LAMR is the symbol. It's basically a REIT, but it's not a traditional REIT. They own billboards. And so they rent out billboards, both digital and traditional. And the yield now is, I believe it's over 5%. I haven't checked since the price just dropped, but I think it should be over 5%. What I like about this company is a company I've followed for a long time. In fact, when I first became a Wall Street analyst, I had a sell recommendation on the stock, and I was dead wrong. This was 2005, I think, so it's been a while. But management the company has been run by the family since it started almost 100 years ago, I believe. And I've been impressed with management. Even when I had recommended selling the stock back in 2005, they always took my calls. They let me ask questions on the conference calls. So that told me that this is a company that has nothing to hide, that management is confident in its ability to run the business, and they're just a very steady performer in that they know their business. They don't overreact when things are bad. They don't overspend when things are good. They really know their business. They know the markets, and the digital billboards are really getting they're really getting pretty advanced in that it's not going to be unusual I don't know, a year, 2 years, 3 years down the road, for you to be driving and it's going to say, "Hey, you in the beige Toyota," and an advert, and it'll show you an ad that is probably relevant to you. So they're one of the leading billboard companies. They've been around, like I said, for 100 years, and I think they're a really, really interesting company.
Yeah, and that's when you read the ad and you drive off the road, right?
That's what I've always been concerned about. But
yeah. I mean, I say that because just going into Manhattan, you see all these digital billboards all the time, and everyone's looking up, but you can just see it. It's so funny. But no, I'm familiar with Lamar. It's a very good company. So listen, Marc, I'm excited for you. I'm so glad to see your book doing well because you're a good guy, you're a good analyst. I've known you for a long time, and really, really great stuff. So I'm happy for you. And and thanks so much. You've been a big help for me too, coming on this podcast all the time. And I know my audience appreciates it. More important, I appreciate it as well, man.
Oh, my pleasure. I love coming on anytime.
Good luck. Keep selling that book, and I'll talk to you soon.
Great, thank you.
Great stuff from Marc. And Marc's been a friend, like I mentioned, for a long time. I know he works hard. I know he cares. He always comes on this podcast. He's always willing to give ideas and share ideas and stuff like that. So I'm glad to see his book's doing well. I'm not surprised. And listen, I don't get paid a dime for the book or whatever. I just, he's a good friend. And just because they're friends doesn't mean I'm going to have him on the podcast and say, buy this book. I actually read it and liked it. That's why, so it's never, I don't care if you're a friend or not. If you write something or have a bad business, I'm never going to put it in front of tens of thousands of people. That's not, I don't care how good of a friend you are, because it's not about friends, it's about business. But, this is a book that I read that I liked a lot. So I just figured that, hey, maybe you might be interested. If not, no worries. But I don't get paid anything for it. And that's why I really don't promote too many books, because there's not a lot of books I read out there in the investment community that I really like that are going to help you. A lot of them are outdated. A lot of them are more about the author just trying to make money because he's famous and he knows he's going to get upfront payment and stuff like that. And it's just kind of BS stuff that I think is a complete waste of your time. So, I'm glad Marc came on and talked more about it. And he followed up as promised too. Not just talk about his book, but he went to the JP Morgan Healthcare Conference. He said he was going to come back on and give you the scoop. And that's important because these conferences could cost upwards to $5,000 to get in. I pay for a lot of these conferences sometimes. So getting the inside scoop for free on a podcast from a great analyst who's been in the industry for 10, 20 years, it's great having these guys on and talking about what they see. Even when I go to the Consumer Electronics Show, if I go to Ira Sohn Conference, the Value Investing Congress, even though a lot of those high-end conferences get marketed on CNBC now, and right after they make their presentation of the stocks they're buying or shorting, channels will come off and go around on CNBC and tell the ideas. So I think it takes a lot of value away. That's why I didn't really go to the Ira Sohn Conference this year, even though it's really great. You have the best money managers in the world there, but it's nice to just get the scoop from someone inside these conferences. This way you don't have to go there and pay a ton of money because these things can get very, very expensive. Now, let's get to my educational segment. I get this question all the time. People always ask me, Frank, how do I find new ideas? That's one question I get. The other question I usually get is, what's your favorite, out of everything in your portfolio, what's your favorite stock? And I always say the same thing. If I really only like one stock and I knew it was going to go high, I'd only recommend one stock in the whole portfolio. You got to buy them all. But the other question I get is, how do you find some of your greatest ideas? Since a lot of the ideas I put, especially in Curzio Venture Opportunities, are unique. Some of them you heard of, and most of them you haven't, and you're learning about these companies for the first time. Sometimes it's difficult for me because I'm finding these ideas, and when you have, say, a company like Apple that has like 55 to 60 analysts covering it, you'll find information anywhere. But a lot of times when I'm recommending the stocks, I'm one of the only analysts there. So when I have a model or when I'm analyzing this company, when I come out with my numbers, those are kind of like the street numbers. Now, anyone's going to recommend it afterwards might see my research. And they may say these numbers are aggressive or conservative, and a lot of times I'll say that about whatever company's estimates. But you have to almost do your homework from scratch, from the ground up. So it's difficult. You don't have all these companies covering it. It's easy to get research on it. You know exactly what's going on. Well, you really got to dig into the company. You got to talk to the CEO and stuff. And I find these unique ideas. Now, how do I find them? Well, one thing is you could screen for stocks, which I do for most investors, just like everybody does. But when you really want to find the small microcap companies, a lot of these names will not always come up on screens. So say if you're looking for earnings growth, and if you're looking at earnings growth, that eliminates most small cap biotechs and every junior mining stock because they're not generating earnings yet. Some of them aren't even generating revenue yet. So it's not the easiest thing when you're looking at screens to find these stocks. Another thing that I've told you in the past is you have to be in the room, and that's something, it's my job. right? The average investor usually has their own thing that they're doing that they're professional at, whether it's a lawyer, a plumber, a doctor, you own your own stores, you own your own business, whatever it is. So you can't travel across the world. You don't have the contacts, you have the contacts in your industry, but you don't have those contacts that I have where I can go out there and really see these ideas. And actually, we always call it, being in the room. And that's why I subscribe to Curzio Venture Opportunities, where I do a ton of this work. And it's also why the price tag for this newsletter is really high, because, you're getting a story, unique pick, and also world-class analysis. Now, getting to the point here. Outside of traveling, outside of being in the room, having great contacts, share ideas with me, and using those traditional screens, one of the best ways to find new ideas is looking at insider buying every week. Don't laugh, because it's more than just looking at insider buying. Okay, you say, well, I find the insider buys. Yeah, I see them sometimes. It's not that. It's not just insider buys, but it's looking at 13Fs. And I covered this before, but not in detail like I'm going to do right now. So 13Fs is where hedge funds, money managers, when they manage money, I think it's over $100 million, has to disclose their holdings every quarter. So that's the names they bought or sold over the past 3 months. Now, some of these firms are high-frequency trading firms, meaning they have a high turnover. High turnover is that they get in and out of stocks right away. It could be days, could be weeks. What does that mean? It means that by the time they release this report, this is high-frequency companies, say like a Bridgewater or something, they might not even be in those stocks. So you have to be very careful to see what type of fund you're looking at. But with me and my systems, I have hundreds of these that come out. And all the top investors, all the biggest funds and multi-billion-dollar funds, everything comes right out for me because of the systems I have. You could find a lot of this stuff, some like clunky of free sites and things. But for me, I could just post it up and I'll see literally hundreds of these firms and what they're buying and what they're selling. And it really provides a good perspective. Not so much that I want to buy in after these guys or what they're selling or what's going on, but it really can give an indication of, hey, these could be good ideas, or why are they buying this stock? I mean, that's what you want to ask yourself when you're looking at it. Like, why are they buying? Why are they selling? And you could really find great ideas. Like, for example, Teva Pharmaceuticals is a company that I was wrong on. I really liked a lot higher, came down, stopped out, and it even came down a lot further. So it's a name I was really wrong on. And when when you're really wrong, you hate it. Your emotions are involved. You're pissed. I don't care if you're the greatest money manager in the world. I don't care if you're an amateur investor. You're pissed. You're like, oh, I'm not even gonna touch that, whatever. But it came down to levels where it was completely out of favor. And you know what? Buffett and Jana Partners just disclosed a new position in the stock, which is interesting. Again, this is a company that came down a lot. Now you have value investors jumping into the name. You look at George Soros taking a position in Overstock last quarter. Overstock moved tremendously. Why? Well, the cryptocurrency exposure, the T0 platform, the trading platform that they're launching. But you missed the boat most of the, for Soros to buy Overstock. I mean, these guys, you have to realize, I'm going to tell you something, okay? When you have a guy like Soros or you have a guy like Einhorn, when they're about to invest in a company, if they call the company's CEO, I mean, that day they can get a meeting with them, right? That day. So Soros didn't just magically invest in Overstock. I mean, this is a Sears investor, huge billionaire that has an amazing research team, but they probably sat down and whatever they said, they were very impressed with Overstock, which seems like the catalyst is mostly realized here. Because I can tell you, Overstock at this level, and I think, as a cryptocurrency play, it's not a bad cryptocurrency play at all. I mean, they have a legit platform. You have, crazy CEO Byrne who's vocal, and I think he's going to, do great with this part of the business. I mean, this was part of their business for 2-3 years. Nobody cared, right? Nobody cared until it last 6-9 months when cryptocurrency started going through the roof. Now everybody cares, and it pushed Overstock's stock up tremendously. But why are you buying it now? That's something I want to dig into, because I would think Overstock, I don't know if I'd buy Overstock on cryptocurrency right now. It is a good company. But the fact that you have, a great investor, I know people have personal feelings and personal things, political against Soros. Take that out. Just don't even think about it. This is about investing. It's not about friends, not about if you hate a guy, love a guy. The guy has a lot of money and he's investing in a stock when it moved up tremendously. When I think the story played out, that was interesting to me. You look at Greenlight Capital, David Einhorn. Great investor, taking a sizable position, JCPenney, which has run up nicely. They report this week. See what happens. But I can't picture David Einhorn and his research team going into a meeting with JCPenney and taking a sizable position, millions of shares. And listen, I'll say it, but I can tell you, from someone who's been in this industry for a long time, I would be surprised if JCPenney just completely bombs the quarter completely. You know what I mean? So I think there's a lot of research that's done, a lot of talking that's done, and it's probably, listen, this is a position that David Einhorn's not looking to flip or anything, but getting in at the ultimate cheap price and talking to management, these are guys that are able to get great meetings, especially with large cap stocks. A lot of those guys sometimes don't like newsletter writers unless, you have an in, you have a big following. I can get in a lot of those meetings, but also it's difficult, especially for large cap stocks. They're going to talk to the David Einhorns that could take $1 billion positions or $100 million in their stock. So, that was interesting to me. JCPenney. Third point is Daniel Loeb, brilliant hedge fund manager, taking a position in a stock that I don't like, that I'm worried about due to massive debt and expenses. That's Netflix. He's buying Netflix last quarter. He's probably up a ton of his position. That stock keeps moving higher. And this isn't a company that just has, I have debt and we're going to pay it over the next 5 years. And, 25% of that debt is due over the next 3 years. So they're okay and they can raise. These guys have to pay an enormous amount of money for content. Billions and billions of dollars. I mean, that's not going away. So you're being forced to basically make your own content, which Netflix is great at. But to do that, it's very expensive because why would they have? They have Adam Sandler. You can make fun of Adam Sandler, but Adam Sandler's a big draw. Now here you have, how many actors are you seeing in so many of these shows now? I mean, Ozark, great show on Netflix. I mean, they have great content, but now they're paying full price. And Will Smith, they just did something with, too. So they're paying full price for the superstars in this industry, which are huge costs. So you have third point, Daniel Loeb, I would say kind of a value investor buying Netflix, right? Interesting. I'm not telling you to buy it, but it makes me want to dig further. I'm not saying to buy these stocks just because somebody bought it, but it's cool to put them on your watch list because you might say, well, Soros bought Overstock and Overstock goes down 30%. You know what Soros is going to do? I don't think he's going to sell it unless there's drastic news. He's probably going to add a lot more. So you may find support for that stock when it comes down if they miss a quarter. And that is pretty cool. Fairholme Capital, Bruce Berkowitz, huge owner of Sears, believe it or not. Well, as the last quarter, this was reported. They released their holdings less than a week ago. He reduced his stake from 20.5 million shares to 24 million shares in Sears. And like we saw with Buffett and IBM, they can't get rid of their whole position right at once. Unless they have someone that's, going to buy the entire bulk, which is not going to happen in Sears. But if this guy continues, that's a lot of shares. So, and that's, he reduced his position pretty much by a sizable amount. So if you think about getting Sears, you may want to wait because it looks, and look, the trend's been strong in department store retails, and we nailed that. But when you're looking at Sears, that's a lot of shares that look like are going to be sold. And how do you know? Look at next. So that's what you saw with IBM with Buffett, right? He sold some of his position one quarter, so he started selling like the last 3 quarters, and now he announced I'm officially out of it. IBM's a much, much bigger stock. It's fine. Right? It could hold up, and people are buying it. And they have, I kind of like IBM here, transition their business. But when you look at Sears, that's a lot of selling pressure. So if you have any thoughts about buying a Sears, I haven't looked at Sears. I haven't looked at Sears in a while. I know it doesn't look good. I know you say Sears. Every Sears I go to is lucky there's 2 people in the store. There's more people working there than people in the store. Every Sears I've ever went to, I think, for the past 5 years. So, but if you look at it as a value play and trying to spot value and things like that, just, you probably get at a cheaper price when you have a pretty much one of the largest shareholders selling their shares. So let's see next quarter how much they sold. Maybe they sold another 4 or 5 million. But you're going to see that constant selling pressure from this. Civil Point Capital bought Hertz at a great price. This is a company I loved under 10. These guys made great money in positions, a fantastic fund. And then you know what? This quarter, they closed their position. Interesting, right? Because Hertz just came out this week and warned, and the stock fell. Good timing. So just the little things that you could pick up. But if you saw this, I mean, they released this over a week ago. So if you look at Silver Point and say, wow, they just sold Hertz, I don't know, maybe they give you an indication because Hertz 1 week later reported a horrible quarter. I'm not saying it always works like that, and maybe that's the biggest coincidence, but just little things you want to pick up here. It's more than just looking at insider buying, but look at the details. And I saw a ton of big, massive firms buying Time Warner. AT&T's looking to buy Time Warner. Yet the Justice Department is trying to block this deal, even though they have zero case. Zero case. Political than anything. So the fact that they're buying this, and Time Warner sold off when the Justice Department came out and said, hey, we're going to block this deal or whatever, and AT&T's fighting it and taking it to court. But does that mean they believe this deal is going to go through? And I can tell you one fact when it comes to multi-billion-dollar hedge funds, they have massive political connections. And they hire the top people right out of the SEC, former Fed governors. They have billions of dollars. They hire the greatest talent in the world. They donate a crap load of money to campaigns. What does that mean? Those are bribes. I'm sorry. I'm going to say it. You can kill me. I don't care who's listening to us, but that's what it is. You don't donate money to a campaign unless you're going to want something in return. That's why you donate money to a campaign. Whether it's, hey, leave us alone. Give us a heads up if you're coming after us. Listen, we're really like this part of the industry and we'd like to see you more focused on this. So maybe you could vote, whatever it is. That's why you donate so much money to campaigns. You don't donate because, you know what? You're a really good guy. I like your hair today. Here's $10 million. No. You donate that money to get something in return. That's called a bribe. It is. Unfortunately, you can't say that. You're not allowed to say that. But that's what it is when you donate to political campaigns. So these guys get the scoop on a lot of stuff that's going to happen on the political front, which could change. Could result in huge fundamental changes in any industry. The fact these funds are taking a big position in Time Warner tells me they believe the deal's probably going to get done. AT&T was looking to pay around $107, $110 a share for Time Warner. It fell to $92. So you're looking at a 15% discount from the actual acquisition price. It's a little bit above that now. But this may be a great way to play AT&T, right? It's like you're buying AT&T almost like at a 15% discount kind of, right? Since if this deal goes through, they're going to do it at 107, 110, around there. I'm not too sure exactly what the price is. But you're going to own shares, and then once they convert, or if AT&T does buy Time Warner, they're going to convert to AT&T. Whatever. Don't worry about the ratio. Just know if you have $20,000 in Time Warner, it's going to be $20,000 in AT&T, and then you're going to go AT&T. So instead of buying AT&T here, and AT&T may fall a little bit. Again, it's all arbitrage situations and stuff. But it's interesting to see how many large funds took a position in Time Warner this quarter. And I can tell you something about AT&T. That's going to be an amazing, amazing company if that deal goes through. And you're looking from an old, slow-growing wireless company into an advertising giant like Google, where they're going to have some of the greatest content, right? A massive library of content from Time Warner, and they have basically the biggest platform in the world to distribute it to. Not in the world, but in the United States. And you're looking at all the wireless subscribers that they have, hundreds of millions, well over 100 million. DirecTV subscribers, and now the internet subscribers, right? They're laying fiber everywhere. But that's a massive distribution system platform so now you want this content and how can you get advertising dollars and have the whole package here. You say, well, maybe the Justice Department is going to come after them. That's why they're blocking the deal. It's two totally different industries, though. It's if you're blocking this deal, then you should have blocked a bunch of 5 or 6 deals before this. So a lot is political, but something to look at. And guys, it's not just 13Fs, but insider buys from CEOs and directors. And I just found my last Curzio venture opportunity pick this way. It's a tiny company, incredible upside potential. I never heard of it. I guarantee 99.9% of people listening never heard of this name. I've been in this industry for a long time. This is a company that's over 20 years old. I've never heard of it. It's a very small company under $10. Never know it existed. But their technology has a very, very, very good shot of making its way in almost every new smartphone built that's going to be built over the next 10 years. I don't want to go into story because I don't want to give it away. And think about that. Apple, Samsung, LG, testing this technology right now. And it's kind of amazing. It's over a $1 billion opportunity for a company to generate $100 million in revenue. It's a cheap stock with no debt. I mean, how did I find this? Well, I just scanning through some of the insider buys, and I'll look and say, hey, what's going on here? It doesn't always work. You guys could buy their stock, and the stock can crash. But when you see there's thousands of reasons to sell a stock if you're an insider. You pay taxes. I want to buy a new house. I want to do this. I want to do that. I want to take profits or whatever. And I'm a big believer that if you start a company early and you made a fortune, you should be able to take some profits off of that, right? That's your hard work. You don't want to keep your full position. Your whole life is in this now. So there's a bunch of reasons to sell. There's only one reason to buy. Only one, because you think the stock's going higher. And who would know better than the insiders? Than a CEO, than a chairman. And that's who's buying this stock right now. And the funny thing is, that's only $1 billion opportunity. They have a totally another business. That's amazing. Where they target defense companies. And almost every major defense company is a customer of these guys. And that's another $1 billion. So $2 billion opportunities on a dirt cheap stock. I mean, this is something I would have never found, but this is how you find new ideas. That's the name of the game. It's finding new ideas, trying to find the best stocks, trying to get them early when it's small caps before people are mentioning this and talking about it. And think of a semiconductor that first, that Apple was sampling its technology. If Apple uses them, holy cow, that thing is going to take off during that stage. I mean, later on, it becomes like 50, 60, 70% of sales sometimes. It's one client. You have to be careful. That's why you want to take profits, because if Apple says, we're not using more, that stock's going to crash 60% in a day. But before that stage, when there's no risk, when Apple's not a client, and you see that they're testing it and they're announcing they're testing this technology, it's just in this industry. It's kind of like the semiconductors, right? They can't tell you. You don't know what's in Apple until they do a teardown. So you don't know what's in the new iPhone until they don't announce, we're an iPhone, we're making it. No, everything's secretive. That whole entire industry. Taiwan Semiconductor, there's all fab work. You got Apple, NVIDIA, all that stuff. It's all secret. You don't know who's helping those guys out until you get the product, and they call it. It's called iFixit does it. So it's like the teardown. They go through every part and they can see for the serial numbers. Well, here's Skyworks is in this, and Cypress is in this, and here's Broadcom is in this. Their 3 chips are in it. And that's how you find out who's actually in these things. So it's very under the radar right now. It's pretty cool, but this is something that I found. So the point of this whole thing, and I won't go on and on, is take a look at 13F, see what the biggest investors in the world are buying. Doesn't mean you have to buy what they're buying, but it puts things on your watch list. It makes you dig deeper. Why are they buying Netflix for? Interesting. So point. So Hertz. Now Hertz is getting crushed. Hertz just missed a quarter. Einhorn with J.C. Penney. I mean, big position. So, put these things on your radar. J.C. Penney's reporting this week. If they missed a quarter and it comes down 15%, hey, Einhorn's not leaving the stock anytime soon. He's probably going to add to his position. So put it on your watch list. But that's how you find so many great ideas, at least for me. And this is something everyone could do. You don't have to fly around the world like I do, spend millions of dollars a year, talking to your greatest contacts, which is the great way to find idea. And again, that's why people pay me for my newsletter and pay so much, because that's what I'm doing for them, and do as much research as I can for them. But for every individual investor, this is something you can look at. There's a lot of free sites that track insider buys. Again, the 13Fs might be a little clunky, where I'm able to get them probably in seconds through my research engines that I pay a fortune for. But that's something or reason or ways you could find new ideas. And that's the goal here. We're always looking to find the next big idea, something we can invest in early that has a chance to go up 10, 20 times. And you also want to put a stop on that to limit your risk, because if you're wrong, all right, you stop out, it's fine. But if you're right, you want to make sure that reward is worth the risk that you're taking. Okay, guys, if you're a Curzio Research Advisory subscriber, you're going to be receiving an amazing content on cryptos, including my 11 indicators on how to find the best crypto stocks, a watch list of 24 cryptocurrency stocks that you could make their way into my portfolio. I'm researching all of them right now. You're also going to receive a crypto training course, which is a 5-part video series. You actually tape this. I taped this whole entire thing. A lot of work on it, explaining exactly what Bitcoin is, what blockchain is. It's not just for beginners. Some of it is beginner stuff, but it's, I'm also going to show my method for spotting the best names in this sector, and also the methods of spotting the BS in the sector. So this is on top of my recent issue I just published last week, where I recommended 3 new crypto stocks. There's one small, one mid, one large cap name. So if you're a Curzio Venture Opportunity, you got that issue already. You can get all these reports absolutely for free after you pay me $1 million. No. Everything's for free. All that stuff's coming to you. It's my way of saying thank you. No gimmicks, no special signups, no emails. Again, if you're a current Curzio Research Advisory subscriber, you're going to get all that stuff for free. If you're not a Curzio Research Advisory member, we're going to be opening up this newsletter this week. I mentioned it last week. This isn't a $2,000 a year service like Curzio Venture Opportunities or expense service Mike Alkin's Money Flow Trader. This is a monthly newsletter where you're going to get at least 12 new stock recommendations, quality research, and I'm going to set the price for you at under $100 for podcast listeners over the next 2 weeks. It's not $100 for a month. It's $100 for the entire year to get access to that. And so I know a lot of people are like, hey, Frank, I'm thinking about subscribing. If you think about it, next 2 weeks is going to be the best price by far. And you're going to get all my crypto research, everything I mentioned, the watch list, the 3 new ideas I have. You're going to have my cryptocurrency playbook, where I have all the indicators, 11 indicators, how I spot stocks in this and everything like that. So if you're going to subscribe, I get a lot of emails you're thinking about. I do next 2 weeks. If not, no worries. I understand. It's perfectly fine. And for the Curzio Research Advisory members, you're going to get all this stuff for free. Just my way of saying thank you, because you've been following me for years. Thanks to you, we're able to build this business, and it's going well right now. So I want to try to provide the best stuff I can for you guys, and expect all this stuff to come out this week. So that's it for me. Thanks so much for listening. I'll see you guys in 7 days. Take care.